So this is Professor Mike, and we're going to talk about the capital acquisition and repayment cycle, which really means, issuing debt or issuing equity, and in the case of debt, repaying that. So characteristics of this cycle, again, like fixed assets, the transactions, are more infrequent and they tend to be material. And so we audit the transactions rather than the balance because if you got long-term debt from last year and you have either additional borrowings or maturities of the long-term debt that you've made repayments on, it's relatively easy to audit those. You've already audited the long-term debt beginning balance as of the ending balance of last year, so there's no point in going back and doing the entire thing. Of course, you will confirm a debt balance. So in essence, you have audited the balance, but you're really looking at transactions. The same thing goes for equity. So, if you miss one of these transactions, it could be material. The other thing is, you know, the the fact that you need to audit equity. A lot of times, especially right before an IPO, right during an acquisition that's been announced, people will come out of the woodwork and file lawsuits claiming that they were owed shares of in the company, or they'll dispute their ownership, or as employees they'll claim that they didn't get to exercise their options or things like that. So what you really want to make sure of is that the controls around issuance of equity, issuance of stock options, and those types of things are very strong, so that you know what the company's equity is, and if there is a transaction, you're in a position to support it and defend against um, potential litigation. So you as an auditor are mainly verifying that those things are in place. Um, it depends on the structure of the business, right? A software company in Silicon Valley is probably going to be venture backed, which means it's going to be heavily equity or quasi equity instruments like convertible preferred stock. Um, i the redeemable convertible preferred stock. You've seen some of those in some of the IPO documents you've gone through. And then in a more commercial enterprise, local enterprise, a lot of those things will be more about maybe bank debt, things like that, not so much equity. And certainly in an LLC or LLP, there'll be not a significant amount of equity and maybe some debt for leverage. So you know, here's the transaction flow for notes payable and the related interest. Basically, notes payable is a legal obligation to a creditor that you have to pay on a repayment schedule, which might be interest only, might be principal and interest, might be a balloon note payment. And the notes payable are usually material enough that they're authorized by the board. So a lot of your controls around notes payable are ensuring that there's appropriate approvals and board level approvals for significant debt, and there perhaps may need to be shareholder approvals as well to make sure that that there isn't any encumbrance on the assets of the company. So those are the types of things you're looking for. The other thing is, categorization of notes payable and accrued interest by current, non-current, because the current ratio is something that a lot of people study and look at any potential liquidity issue, and so the categorization of those into current and non-current appropriately is important. The other thing is disclosures need to be appropriate. A lot of times there are covenants, which are things that the company has to comply with. So it might have a cash balance covenant, it might have a current ratio covenant, It might have a debt to equity covenant. All sorts of different things could be in place, and you have to be in compliance with those. Sometimes the covenant will be that you need to provide audited financial statements, which may be why you're actually doing the audit. So, um, the I spoke about the proper authorization. Controls around repayment of principal and interest is fairly straightforward, and it really is all about documentation and understanding what's in the notes and what the covenants are, what the repayment schedule is, and then some independent verification based on correspondence or other items with the note holder. Um, so you can do a lot of substantive work, especially on interest. Analytical procedures on interest are probably very effective, and then a confirmation of the notes payable for with the note holders. Um, and even if you paid off the note, you will confirm with the note holder, the former note holder, that the debt no longer exists because remember your risk is understatement. So you can see these types of different substantive analytical procedures for notes payable, and you can do different analysis. Now moving on to equity, there was a lot of issues in the early 2000s around stock option repricing, and basically at that time it is alleged that a prominent law firm in Silicon Valley was telling their companies that it was okay to reprice stock options at a low price or vary the date that stock options were priced. That is not GAAP, and that is also not allowable under the tax law. Many companies did it based on that advice or knowing that somebody else had done it. And one of the companies that was actually prosecuted for this is Brocade. And basically, the CEO, Greg Reyes, would select the lowest price date, using hindsight, and then backdate the stock option grants to that date, so that essentially his employees got a built-in gain based on the picking the lowest stock price. Um, the appropriate thing to do under the accounting at the time was to um, issue the stock options and options wherever it landed, and choose a date and backdate the agreements. So as a result, a bunch of other documents were falsified to cover this up, um, and he didn't recognize compensation expense that should have been recognized, and there were tax consequences as well. Excuse me. But Reyes actually didn't get hit with penalties. It was actually Tony Canova, the CFO, who was a former coworker of mine at KPMG. He took over for another CFO who had participated in the backdating, and it's alleged that Tony became aware of the scheme but didn't report it. Um, so he got in trouble uh, for uh, for signing the 10K for Brocade, knowing that these stock options were not properly issued. So the perpetrators actually didn't get as penalized as they should have, and the guy who failed to report it got penalized. You can make your own judgment as to where that's fair or not. So the transactions in owner's equity, you guys know these from intermediate accounting. Most of it's around issuing stock and then putting it into common stock and then or preferred stock, depending on what the case is. A lot of times in the Valley, it's preferred stock, and then additional paid-in capital is appropriate. Um, Again, the Valley, not many dividends, so you don't have to worry about dividends in the Valley. Obviously, in other more mature industries, you do see dividends. Um, the owner's equity accounts include the common stock, paid-in capital, and retained earnings. It's pretty straightforward, but the contingent equity items include stock appreciation rights, which are less common, but restricted stock units and stock options are two of the big things that you see, and then warrants. For all intents and purposes, warrants are essentially the same as stock options. Stock options are issued to employees and consultants. Warrants might be issued to banks or um, you know, to other companies that you're doing business with as an incentive to, as an incentive to do business with the company or to be the banker for the company. In Silicon Valley Bank has made a ton of money on warrants, as has WTI, the company that Bruce works for. So they'll not only lend money to a company, but as part of the lending agreement, in lieu of as part of the overall earnings on the loan. So instead of charging a higher interest rate, they'll charge a slightly lower interest rate and take warrants and hope that the warrants are worth something. So, stock options and warrants are both issued at price on date of grant, at fair market value and date of grant. And the hope is that, if you issue these at a buck, that the stock is eventually worth $10. And so you're able to exercise your warrant or option for $1, which means you pay $1 and get those shares, and you receive $10 in value. So it's either a warrant or an option is the right to purchase a share of stock in the future. And those are a lot of the contingently issuable securities. There are also restricted stock units, which are, rather than an option to purchase, they're actually a grant. And so you think, oh, well, I'd rather have a restricted stock unit than a stock option. Well, a couple things. One is you're taxed on a restricted stock unit when it vests, when you have the right to own it. So, when you're in a private company, that right to own a restricted stock unit is great, except that you have to pay tax on it before you're able to actually liquidate it because private companies are, in rare circumstances, you're able to liquidate the stock, but in most cases, not freely tradable. So you're paying taxes on something that you hope is worth the basis that you're paying taxes on. Folks at Uber and some other companies have had unpleasant experiences with this. Certainly, WeWork people who got restricted stock units paid taxes on something on a valuation that was never going to happen. That's why private companies tend to not issue restricted stock units. The what you're doing in owner's equity is really making sure that you've got good, strong controls over the equity, that you know who owns your stock, and you know who has a potential option or warrant or restricted stock unit available to them. All these transactions involve the board of directors and potentially other shareholders. So the authorizations are a big control. Okay. Record keeping is now much easier than it was back in the day. Your lawyers could keep the records for you, but it's better now to use a third party tool like a company called Carta, which does equity tracking and gives you a complete capitalization table. Cap table or capitalization table is at its simplest a list of owners and potential owners and the number of shares that they have the rights to and any strike prices. Um, what it really is a way for you to calculate if you give different values on the company. It's a way to calculate how the liquidation of the company would happen based on the number of shares outstanding. Um, so there's four main concern in auditing capital stock that everything that exists is recorded. So it's a completeness test. Everybody who has a right to stock has it reflected in the capital stock agreement, right, or in the capital stock record. Make sure that the transactions have occurred and are appropriately recorded. Um, and it's appropriately presented and disclosed. So making sure that all those contingent uh, stock issuances are reflected in the financials. Um, the dividends, that's another transaction-based thing. Those are declared by the board of directors, uh, declared and approved by the board of directors. So you're going to have information about those, and then it's really about the computation and the record date. Um, the paid in capital should be pretty straightforward. That's just the excess of stock over par value that's issued. And you can do recalculations on that. And again, you're testing this based on transactions rather than on balances. So often a third party transfer agent will hold the shares of the company in the record name of the shareholder, and it's easy to do a confirmation with them and make sure that share transactions are appropriately recorded and balances are appropriately kept. Okay, on to chapter 23.